Hey all, happy Monday. And another short but very informative interview, this time with Brent Johnson of the dollar milkshake theory. So it's going to cover the markets, the financial outlooks, the risk of a major drawdown or correction in the markets. And I recorded this at Rebel Capitalist Live in Orlando a couple of weeks back. So enjoy. We're here at Rebel Capitalist Live in Orlando, and I'm meeting a lot of heroes who are on the speaker circuit here, including Brent Johnson.
Nice to be here.
Great to meet you in person, Brent. And you have a famous dollar milkshake theory, which for many of my listeners, they might not be aware of. They're not really in the financial world, but very important to understand. But maybe first you give a brief intro of who you are.
Sure. So my name is Brent Johnson. I have a wealth management firm called Santiago Capital. I've been doing this for about 25 years. I used to live in California for a number of years. I moved to Puerto Rico 3 years ago with my wife and son. And now I get to come to fun conferences like this and meet interesting people and try to learn stuff.
Excellent. And one of your claims to fame is, of course, the dollar milkshake theory. So I thought it'd be great if you could give a kind of a layperson summary of what that is and why it's quite important for everyone, really.
Yeah, well, in a very simplistic way, the reason I came up with this dollar milkshake theory is I work with a number of very smart, intelligent, successful people in managing their money, but they're not finance people. And so I had to figure out a way to explain to them what I thought was going to happen without getting it bogged down in financial lingo or monetary policy details. And essentially what the dollar milkshake theory is the reason the dollar is so important is the entire world uses it. So whether it rises or falls is one of the most important factors that play into global markets. And the dollar milkshake theory is essentially a framework for how I see the years ahead playing out, because I think the debts have gotten to a size where the governments are going to have to be more involved in markets than ever. And I think the debt will eventually cause a crisis on a global scale. And this is the framework via which I think markets will play out once that kicks off. The interesting thing is, even though we haven't had the crisis, the framework of the thesis has really helped me navigate the last 5 years of the markets. And essentially, where the name comes from is the debts have gotten so big all over the world that the way that the monetary authorities and the governments tend to react to it is they provide more stimulus, they do bailouts, they print more money, however you want to describe that. So in my mind, that's the mixing of the milkshake. The governments are providing this liquidity, but for a number of reasons, some of them deserved, some of them undeserved, the U.S. is the one with the straw, and that's the dollar. And I think for a number of reasons, that capital that's created, the capital that already exists and the liquidity that gets created will largely flow into the United States, because on a relative basis, it will be the best amongst a bad group of opportunities. And that will push the dollar higher, but will also push U.S. asset prices higher, which is largely what we've seen, since COVID, right? The dollar went down a lot after COVID, but since then, it's been rising. U.S. equities have risen, gold has risen with it, and so that's essentially what I thought would happen when I first started talking about this in 2018. I thought there was like 5 things that would happen. I thought the 40-year bull market in bonds would end. So I thought bond prices would fall. I thought interest rates would rise. I thought as interest rates rose that would pull the dollar higher with it. As the dollar went higher, it causes problems elsewhere in the world, and then that will also draw capital into the United States. And that's largely what we've seen happen. And so it's not perfect, and I won't get it 100% right, but it's definitely given me a framework via which to try to navigate the craziness that's going on.
Excellent. And no, I love the word you use, framework. It's not a be-all, end-all. It's a prism to view what's going on. So it's excellent. So just for kind of lay people out there, I have a very simplistic attitude from what I've learned from the financial systems, macroeconomics. I've kind of moved a fair chunk of my family's kind of wealth. It's not big wealth, it's just wealth, into physical gold as a hedge. I'm in the equities maybe 50%, but I'm really concerned with the S&P, and my pension fund largely just follows the S&P. And then there's some other reserves which I'm waiting for opportunities. So how do you see things play out with, let's say, the broader market, the S&P, that's now at all-time highs? The next year or two, where do you see that going?
Well, the timing is always the hardest part. And so the first thing I'm going to say is I don't know. I can tell you what I think is likely to happen, but this is not a guarantee, and you always have to be ready for it to go opposite. I think what has happened over the last 3 or 4 years, we're going to see happen even more over the next 3 or 4 years. So I think gold goes higher, I think the dollar goes higher, I think U.S. equities go higher. However, markets don't move in a straight line, and I don't think this will be easy. I think everything is kind of at its highs now. Precious metals are at their highs, Bitcoin's at its highs, real estate's at its highs, equities are at their highs. I think what's more likely than not is that we will have a correction of some kind or a pullback. And maybe it's just a pause, maybe it's a sharp drawdown, I don't know. But I think what happens is there is a kind of a short-term risk-off event that then provides the cover or the opportunity or the reason that the governments will start injecting more liquidity again. And then I think everything kind of ramps up similar to what it has over the last couple of years.
Right, so that event, you could view it as a correction, or maybe it'll be a very large correction, perhaps. Hard to know. And the timing vis-a-vis the election, because this is one that I'm kind of intrigued by. It's not in the political interest to have a major correction and disruption before November, and yet you would kind of expect the system should maybe before November. What's your thoughts on that?
So I agree with you, that's not ideal timing. And my guess is that should something happen, the Fed and the government's reactions will be fairly swift in order to kind of prevent chaos ahead of the election. But I would say also that just because governments don't want it to happen doesn't mean it won't happen anyway. I think sometimes people forget that the great financial crisis started in the summer and the fall of 2008, which was right during the height of the presidential race between John McCain and Barack Obama. There, at one point, they even suggested both stopping their campaigns to go back to Washington, D.C. to deal with the financial crisis. And so again, it's not that it can't happen or not that it will happen, but I think sometimes people will say, well, that can't be allowed to happen so that it won't. But sometimes even though things that can't be allowed to happen anyway. So I think it's important for people not to be so certain about what's going to happen. There's some people who are certain that the market's going to continue higher. There are other people who are certain that it's going to crash. I think as an investor or an allocator of capital, I think removing the words always and never from your vocabulary is probably one of the best things you can do. And just kind of, I think this is a time of great uncertainty. And so I'm always surprised when I meet people who are so certain they think they have it figured out. Just buy gold, just buy Bitcoin, just buy real estate, whatever it is. And I think oftentimes people have a conviction on something and then they put their whole portfolio into that. And I think it's important to have conviction. I think it's hard to make money if you don't have conviction. But you don't have to put your entire portfolio into something just because you have conviction. I think diversification is important. Some people don't think diversification matters anymore. I think diversification is very important.
Yeah, and I reckon, the physical gold, of course it could correct as well, but with the central bank buying, I know particularly from the East and all the other vectors, it feels like quite a safe hedge. It's unlikely to head back down into the mid, 1600s. There's probably a floor at 2000 now, I
Probably.
guess.
Again, I tend to agree with you, but I also would not say never, right?
It's all probabilistic,
yeah.
Absolutely, and I couldn't agree more. But the market, I guess we'll find out. And if there's an event, you never know the event that will trigger a lack of confidence, and then it could be self-reinforcing and you get a big correction. Sure. And I guess you're right, the governments have a lot of control, and I suspect there's a lot of kind of political link between the Fed and the government. I know there's not meant to be, but I just suspect there is. But they're not all powerful, and the market is like the flock of swallows. It could turn at any moment.
I think the other thing to remember, because the United States is the global hegemon, or still the global leader, and because it does have the biggest capital markets, I think people focus on U.S. finance or U.S. capital markets more than the rest of the world, and I understand why that is. But I think it's also important to remember that whatever crisis happens, it's not guaranteed to start here. It could easily start in Europe. It could easily start in Japan. It could easily start in China. And despite all the problems that the U.S. has, if you look around the world, many other places are in worse economic condition than the United States, and they don't have nearly the advantages that the United States has. And that kind of goes back to my theory. A lot of times people will say to me, well, your theory is really just the cleanest dirty shirt. Everybody's in trouble and you just happen to have the cleanest dirty shirt, but it's still a dirty shirt. And my point is, well, you're right. I don't disagree with that, but would you rather wear the dirtiest dirty shirt? I mean, even though it is, I would prefer the cleanest dirty shirt to the dirtiest dirty shirt. And when you're allocating assets, I think you want the cleanest dirty shirt. If you had a clean shirt, that would be fantastic. It's tough to find clean shirts these days.
But that is precisely, and I agree 100%, it's realpolitik, it's reality. Reality is what we have, and then it becomes all relativism. How do I get the best? To your point.
Well, and I think what's important for especially individual retail investors to understand is, as an individual, if you choose to, you have the opportunity to just check out of the game and put all your money in cash or put all your money in gold and go live on a mountaintop somewhere for 10 years. But the big institutions that put huge amounts of capital to work, and they are the ones that drive markets, they don't have that option. Even if some guy that's running a multi-billion-dollar pension fund, even if he personally thought it was a great time to sell all of his equities and buy gold, he doesn't have that opportunity. There is an investment committee that has made a decision already of what his maximum allocation to these different assets are. So even though you think that's what he should do, and even though he thinks that he should do, there are rules in place that prevent him from doing it. And so it's important to understand that while you as an individual have certain options, the big guys don't have the same options that you do. And where they put their money matters, and where they put their money drives capital flows and then influences all these other markets. And if you don't understand that difference, then you can sometimes, as an individual, mistake what you think is going to happen.
That is a fantastic clarification, actually, and that hovered on my mind, but you've really crystallized it. That is fundamental, that even if the people with the big money movers kind of, maybe they believe what we believe and would like to go into gold, they don't really have the option. No. So the game is constrained.
That's right. Yeah. And it can change. That can change.
Hey guys, just going to pop in for a moment here to discuss something briefly that's really important. So gold was money for thousands and thousands of years. And what makes it money is it's a store of value, which currencies, which are going to fall worse and worse in the coming months and years, they're not real money because they're not a store of value. Inflation is crazy and they lose their value until eventually they fall out of the sky. So gold is something that's still hugely important and increasingly so. And ownership of gold, I think, is a crucial thing going forward as part of your kind of portfolio. So the remonetization of gold is much closer than people think. This article from several years ago, I think 18, went through it in detail. And I'll just go through the last couple of sentences. Capital flows into monetary gold will reflect the need for an asset that is liquid, tested, and trusted. Gold's remonetization is now officially a matter of global monetary policy, and this is based on what's been happening. So to give an idea, the Bank of International Settlements, the central bank of central banks, massively powerful in dictating policy. In 2019, they quietly moved gold from 2B in the asset tier to tier 1. So they moved it all the way up, sharing the spot with the US dollar sovereign debt. It's the only other tier 1 asset, and they made that decision quietly in 2019. And the reality is that the central banks are buying and buying and buying over the last few years. So the smartest money. And you can see here 22, 23, and 24 is no different. Increasingly, they are hoarding large amounts of gold. That's driving the price up, but I think more importantly, you can see where the smart money is going, and increasingly that's happening outside the central banks. If you look, the East is buying most heavily. You can see there China, well, Poland's there too, Singapore, Libya, Czech Republic, India, huge country, etc. And the West, not so much, but the West already carries quite a lot. So the gold value at the moment, I actually moved in with my pension way back in late 2020. It was $1,830 an ounce, and now it's $2,430. That's just in a few short years. But again, most experts I follow in the realm believe it will continue going up and up. It may come back a little, as if we get a recession, people need to cover their positions. Gold is so liquid, often they cover by selling gold. So it may move up and down, but it's a 5 or 10 year or 15 year plan. The only way over the long term is up, pretty much unanimous across the board with people who specialize in this asset. So, Pure Gold Company, I do have a relationship with them. I'll put my hand up, and indeed I have a link which will entitle you, if you wish, no financial advice, but if you wish to cover yourself with a portion of your portfolio in the safety, a 5,000-year safety of physical gold, you can go to the guys, Josh and the others in Pure Gold. You'll get a free consultation. They won't talk about just gold. They'll talk about all different asset classes and your personal circumstances. So a free consultation and a free year's storage if you are deciding whether or not you want to take physical possession. So the link is there to get that advantage. And I have found them to be the most excellent. And they service America. They have vaults in America, all of Europe pretty much, and other countries too. So top of the heap there, and they're in Exchange Square in London. They have 2 offices there. So solid as a rock, or solid as gold perhaps. And now we can get back to the interview.
Yeah. And as mines change and as markets move, if gold starts to perform, sure, they can. I'll just give you an example. Perhaps they have as their investment mandate, the investment committee has said you can have up to 5% of your portfolio in gold. That's actually a fairly high allocation for an institution, but maybe they do. Now, if they were to change that and they were to take it from 5 to 10, that would be a huge move for the gold world, because the gold industry is kind of small, right? And so if an additional 5% of pension fund assets around the world started to go into gold could go to $5,000 just like that. But you have to remember that there's still another 90% of their portfolio that has to get allocated to other things. So when you're allocating 5%, it's going to impact the gold world. But when you're allocating the 95%, it's going to impact stocks, fixed income, commodities, real estate. And so you can't, in my opinion, it's a mistake to just focus on the 5 and forget about what they're going to do with the 95.
Yeah, absolutely. And just, again, there's no certainties, but predictions. I'm watching all these people with different opinions. One extreme version on Adam Taggart, I think it was. I think he's a good guy. I watch it. I've seen you on Adam, yeah. But he had one guy on, or could have been Kick Code News, who made a case, and I didn't believe it, that gold could go right back down under 2,000 and even to 1,500 or 1,200. But overwhelmingly, however, outside of that guy, it seems to be the judgment that gold will probably continue to head up over the coming years. So it's not a speculative make money thing, but probably it's a good hedge that also will keep up with inflation and maybe give a little bit of return.
Well, yeah, I mean, I think that gold is one of the most, if not the most, portion of everyone's portfolio. But I don't think they should have 50, 60, 70% of their portfolio in gold. And I think that's kind of the biggest mistake I see make is they have a lot of conviction around an idea, which is, it's great to have conviction. But a 25% position is an enormous position. It's enormous. And anything over 10 is pretty big. And so, because you just never know what's going to happen, and I'll give you an example on gold. And again, this is not me talking bad about gold. I think gold's crucially important. But a lot of people in 2011 felt about gold exactly how they feel now about gold, and yet it didn't happen. Now, it doesn't mean it won't this time. Maybe it will, but there's just no guarantees. And so I think if you're 25 or 30 years old and you have a 25, 30-year time horizon, it doesn't really matter whether gold pays off right now. But if you're in retirement or moving towards retirement and you have half of your portfolio locked up in something that goes down 20% and stays there for 2 or 3 years, and you have to draw on your portfolio for living expenses or income or whatever it is, that's where you have to be careful. And so I think it's important, and that's why I say you shouldn't be overly concentrated in any one asset, because there's just no certainty in this world. I wish there was, but there just isn't.
Certainly isn't, especially since 2020, I think. But no, absolutely. I consider myself a maximalist when I push towards 20, just as a private individual. So I absolutely agree. Big numbers, bit scary. 2 quick things. I'm conscious of your time, but I got to ask. One is Bitcoin, and I'll say up front for what it's worth, it scares me a bit. I don't fully understand it. I've got a small amount, but I just worry at some point the government's cold, icy hand could come in and connected to, criminality and drugs. I just feel it could get regulated, it could get controlled. What's your thoughts on Bitcoin?
Well, conceptually I love Bitcoin. And I don't think, my biggest issue with Bitcoin is that I think the maximalists with Bitcoin who think it cannot possibly lose. This is only a matter of time, and it's basically a mathematical certainty that it takes over. And I just go back to what I was talking about other asset classes, is just nothing is certain. And to become what I think the maximalists think it will become, it is going to have a major battle with the state at some point. And I can't guarantee that the state will win that battle, but they will not just roll over.
I think that's a great way of putting it.
So the people that say the state cannot possibly win, I say, well, the state's been around for quite a while. And usually when a state fails, another state takes its place. So I think the idea that we're going to move into this libertarian utopia where there are no more governments and they lose all their power and it's just this free loving, easy, peaceful society that's probably a low probability event.
Yeah, I think the 60s and 70s are calling and they want their hippies back. Yeah, absolutely. No, I just think, and the power of governments we saw during the last few years, all you need to do is cast shade on it in terms of criminality or drugs, and then the vast majority of people don't know anything about Bitcoin, so they'll go along with it.
Sure.
And these are the threats that are kind of self-evident to me. Very last thing, what was I going to ask? Commodities super cycle.
Yeah.
So that's not guaranteed, and of course the way the world is going, if there are big corrections and problems, I guess commodities can go down as well. But there's a broad feeling among the better, or my more favorite people on Taggart and all the other shows, that over the next 10 years, if you have a 10 to 12 year view of investing, that investing in commodities diversified broadly, and even energy and real fuels, not the windmills, that's probably not a bad punt. Well, what do you reckon?
I agree with it. I think over the next 10 years, commodities will probably do very well. I don't think it will be easy, and I don't think it will be smooth. So I think there's a lot of people who have come to the realization that the debts are too big. The only way to deal with it is the government's going to have to print more money, fiat will get debased, and therefore real assets will rise in price. It's very logical. I think it makes a lot of sense, and I think that will ultimately play out. But markets don't go in a straight line. And I think the next 5 years will be much more volatile than the last 5 years. And so I do worry sometimes, especially when commodities are often traded financially with leverage because they use futures contracts. And futures contracts, again, they have an inherent leverage in them. And as a result, they're more prone to liquidation when price falls. Because when you buy something on leverage and it goes against you, well, then it gets liquidated. And so if you look back to 2000 with the dot-com bust, to 2008 with the global financial crisis, and 2020 with COVID, look and see what commodity prices during those periods of time. They went down 20, 30, 40, 50%. Now they ultimately recovered pretty quickly, and I think that would happen again. But my point is if you go all in on hard assets because you know fiat currency is going to get debased, I think ultimately you'll be proven right, but it could be a very bumpy road along the way, and there could be moments of pure terror while you're sitting there. So again, I think size things appropriately, be careful, have some downside protection, and just the most important thing for me is be nimble. Don't be all in on one thing, be nimble, be able to change your mind fairly quickly, and hope for the best.
Yeah, excellent advice, Brent. And you know what? I did get in a very diversified range. It was, well, kind of a list that Chris McIntosh here has. And it's kind of betting in the next 10 to 15 years on a commodities super cycle. But I do realize I could be looking at 2 or 3 years or at any point with being down 30, 40%.
Yeah.
And you just got to hold out.
Well, the thing with that is it's one thing to say you understand it and you're ready for it. It's another thing to actually live through it.
I think I gotta have to just delete the password for that kind of account that monitors that, and just basically just don't look at it
Exactly.
for 10 years. But again, it's a percentage of my humble kind of spectrum. So to your point, everything is quite diversified, so it's not the end of the world. Yeah. Hey, thanks so much.
Nice
Brent.
talking to you.
You too. That'll do it, guys. Brent is one of the smartest guys out there, and I interviewed several other super individuals in Orlando, and I'm going to release those shortly. And you heard my kind of short piece there on the value of gold. I think it's a crucial part of anyone's portfolio or wealth or pension. Not a massive percentage, but a hedge and a safety play, and long-term a value being stored safely compared to many of the instruments out there and the likely large stock market crash that's probably on the horizon, to be quite honest. So that'll do it, and we'll catch you next time.